Hello everyone, and welcome to our Market Alert video for today, which is September 19, 2025. And of course, this was Federal Reserve Week, where they announced what they did with their interest rates. And we're going to talk about, did they make the right decision, and where do we go from here given the decision that they did make? But we've got more than just that for you this week. We're also going to talk about our bond portfolio. And it's a little bit confusing for many of our clients. We've gotten a lot of questions, so we thought we'd answer those questions and make sure that you are not confused. And then also, we didn't talk last week about something that, in my opinion, was kind of earth-shattering almost, and that is they revised the jobs numbers by 1 million jobs. 1 million jobs. I mean, they were off by 1 million jobs. So we got to talk about, should we use jobs at all in any of our investment decisions or not? And so we're going to dive right into that. I'll bring Jordan Roach, our Chief Investment Officer, into the conversation. Jordan, good to see you.
2 weeks in a row.
Yes, back in the saddle. It's good to be here. Good to see you.
Yeah.
You know, before we get going, I got to tell you that we're going to Houston, both of us are, right, to visit with clients down there and do a presentation and have some fun. But right after that, I'm leaving Houston and I'm going to Austin because my daughter and her husband are celebrating their wedding anniversary. So they're going to take off for the weekend. And so I've got my 4-year-old and my 6-month-old, my wife and I do, for the whole weekend. So that's going to be a really interesting...
There's going to be some good, there's going to be some pain with that.
We haven't done it for a whole weekend with no parents, no help. It's just going to be Faye and me. And from what I understand from clients, it's a pretty exhausting experience, but I'm up to it. But I've been working out. I've been getting in shape. I'm fit. I'm ready. I'm tan. You know, we're ready for this.
I hope you are, because my folks did the same thing when we were in Alaska. And we got back late Sunday night, and they were gone before 6 a.m. the next day. So
they were like, we need to find I need my pillow, and I need to be asleep.
So
yeah, okay. So we'll see. But I'm ready. I'm pumped. So let's talk about the Federal Reserve. So they lowered interest rates 0.25%, 25 basis points, as that is called. And so let's start off with what led to this. Why did they do it?
Well, I think broadly, you know, the Fed all year, the thing we keep talking about, the thing that we've heard, you know, narrative in the news has been inflation. And I think finally they picked up that inflation is not running away like we were worried about, but we're seeing cracks in the job market.
Cracks? How about 1 million jobs revision? Well, we'll talk about that later.
We'll get to that one, right? But they were seeing enough to where, again, the second part of that dual mandate they have, right, that maximum employment, I think they saw that we got to make sure that continues, right? Because you definitely don't want, you know, inflation spiking and growth slowing at the same time. That's stagflation. So they finally saw enough to where I think they said we got to start easing rates.
Yeah, and our economy is like a big giant oil tanker. And you got to start turning that way ahead of time. You can't wait till the last second and then try to turn it.
Yep.
And so, you know, if the jobs are starting to crater, it may be too late already. They may be behind the curve on that, right?
Are they actually late? And we'll talk about this, I think, at the end here. But yes, we started to do it, but yeah, has that already shifted? Okay,
so that leads then to what was the market expecting, and then what did they do, and was there a surprise there?
Well, here is where, you know, I think a lot of people have a narrative that maybe, and they probably are, the Fed somewhat influenced by whoever's in the presidency at the time. But really who they're, I think, beholden to is the bond market. Because I looked back over the last, 20 years, and the Fed has basically cut exactly what the bond market expected each time. So I think, you know, the 25 basis points was what the market was expecting, which is what they delivered.
Yeah, you know, I always tell the story of how the Federal Reserve doesn't lead. It leads from the front. No, I'm sorry, it follows from the front.
That's right.
You know, I've given the example of the dog hunt, you know, in old England. The lead dog doesn't lead the pack. What the lead dog is always doing is looking behind its back, and if the pack went that way, it runs and gets in front of the pack and says, look at me, I'm the leader.
Right.
And so that's what the Fed does with the pack, the pack being the bond market. And
yes.
The bond market said, you better lower interest rates or we're going to have a temper tantrum.
I think that's right. And said that, look, we want to lower them, but we don't need to start out with 50 basis points because that could, you know, show that there's some fear there.
Okay, so then they just did 25 basis points, and in their commentary, they said that that their focus in their commentary was not on inflation, and I hardly heard any conversation about
Almost
that.
none.
It was all about the job market and all of that.
They even, which was, was interesting. They had a little bit of statement in there of saying almost weaker than expected, and sometimes the market can get very skittish when we say the Fed says something about, oh, I'm surprised by this. But nonetheless, the market seemed to be subdued in their reaction. It was kind of what they thought.
Yeah, nothing happened.
A big nothing burger, which is
right.
good. I mean, largely, I thought that we might actually sell the news a little bit, but I think the market broadly, stock market broadly, didn't move much.
I was watching the bond and the stock market when he announced the 25 basis cut, and really nothing at all happened. But then the follow-on, the market went way up. And the bond market did as well.
We had a little follow-on there. Nothing crazy, but we have a little follow-on. And what we've seen is interesting is, stocks have largely held a little bit of gains through the week and post-meeting. You had longer-term yields slightly tick up, which is interesting, is the longer-term yields may be kind of saying, yeah, but what if inflation, what if deficit, what if these things? But kind of a subdued reaction.
Okay. So then the next question is, now we look into the crystal ball, and we say, okay, well, where does this take us? What happens next, given that? And also they said there's a potential for 2 more cuts this year, right? So we might have 75 basis points by the end of this year. There's that talk?
I think it's very likely we do. The next meeting we see in October, then the Fed will have November off, come back in December. I think it is very likely that they end up cutting again. Now, the interesting dynamic here is typically when the Fed is cutting, it's cutting for the wrong reasons at the wrong time, which is kind of when we're seeing like not just little cracks, but chasms, and the market is already selling off. We maybe have some recession already creeping in. That's usually when they're cutting. So you go back, and you can go back to like the 60s and look at this. When the Fed is cutting near all-time highs, there's I think been 20 times this has happened. The market, and this is just context, the market's higher every time 1 year later. Now you have some sell-offs, intermediate sell-offs, but broadly, if you're cutting at all-time peaks, that's a far different dynamic than cutting when things are already bad.
And that's where we are now. There's a lot of talk about, another all-time high, maybe we should sell, maybe we should get out.
Yep.
But you're saying that every time in the past, which does not guarantee the future, but every time in the past that has happened, where the Fed has dropped interest rates at a market all-time high,
markets do well over a 1 year period.
1 year later, the market's up quite a bit.
That's right.
Interesting. Okay,
Yep.
Well, then that tells us maybe that a year from now we should be happy.
I hope so. And we had another big thing we've had today is small caps finally hitting a high that they haven't seen in 4 years. So that's good. So we're seeing a little bit of early wins here. I think we're reasonably optimistic over the next year.
Cool. So, I actually want to share a story here, kind of drop one in. So we were coming back from Alaska, and we were in the airport. Mm-hmm. And, of course, we're all wearing our RPOA swag, our clothing and all that because, we want to advertise, right, wherever you go. And sure enough, somebody came up to us, this gentleman, and he goes, "Are you guys with RPOA?" And we said, "Yeah." And he goes, "I'm a squipper."
That's pretty good. Knew the vernacular and everything.
He knew. He's a squipper, yeah.
That's good.
So, and for those of you who don't know what squipper is the acronym, Squippers is the acronym for Second Childhood Without Parental Supervision. So anytime our clients retire, we call you a squipper. And so there he was. He was a squipper. That was great.
That's
loved
not bad.
It.
A little
Loved
fanfare.
It.
It's
yes.
good. Yeah.
All right. So let's talk about bonds because we've had a lot of questions from clients about the returns on the bond portfolio this year.
Yep.
And they look really low. It's like, what do we made? 2% or whatever it is on the bonds. Why are we in those terrible things?
That's
They're not making any money for me. What's happening there?
Yep.
So let's explain that because they're actually doing far better than just what you see when you look at your statement.
Yes. I mean, the biggest thing when you look at, returns across any asset class, there's always 2 components broadly. There's always going to be the price movement, and then there's going to be some sort of dividend or yield component. And so for our stock portfolio broadly, most of the returns can be comprised in the price movement alone. There is dividends, but it's small relative to the average price movement. Our bond portfolio largely is the opposite, at least this year, where you might have a little bit of price movement, positive, which we've seen, and that's reflected on statements. But the biggest component of their return this year has been the yield.
Which is kind of like interest, right?
Which is the interest they're collecting.
Interest you're getting.
And that's not incorporated into that look. And so what it's doing is it's artificially pulling down what returns are relative to what actually has happened.
So if a bond, and I'm using a hypothetical here, but if a bond made 2% on its price, but it paid 4% on its dividend, then the total return that it made is 6%.
Correct.
But that 6% wouldn't be shown on your statement.
No, when they go look and see how's my bond fund done, what they're seeing is
2%.
it made 2%.
Yeah.
That's right.
And then what compounds it is that when the dividend is paid, we rebalance the portfolio.
That's right.
And so what that means is that dividend gets distributed into everything else as well.
That's right. And it raises the cost basis up, so it even artificially, again, makes it look like it's not as good.
So you don't see, so what happens is the bond dividend is actually put into the stock side, which makes the stock side look better because it was bought into. And the bond side looks like, oh, I'm just over
sad.
here with dividends left. Nobody loves
That's right.
me.
So that is an important thing. So understanding, and that's true of, we own broadly 2 different types of bond funds. We can for clients, and that dynamic is true of both.
Yeah. So overall, as I've looked at the returns of our bond portfolio, they've done quite well, right? Relative to, and especially now that the Fed is going to start lowering or lowered interest rates, and the trend seems to be that they're going to be doing it more. Bonds love that. So now we're going to have the yield come down. Right, hopefully, which drives the price up.
Hopefully,
so now the opposite of what we're just talking about will happen. We should see the returns start to look better.
Good, yeah.
But the dividends should start to trend downward.
That's right. I mean, if we have longer-term yields start coming down a little bit in line with what Fed's doing, then yes, the price component would come up. And so, this year actually is the best year for our bond portfolio we've had since 2019, which ended up being a very, very good year. So, yes, bonds are doing better than what it appears on
the
paper.
Statement.
That's right.
Yeah, and then, like I said, it's just when the dividend comes in, it gets distributed all over the place in the portfolio.
It does.
And so bonds don't get the loving that they should.
No.
All right, so let's dive into this one. And ladies and gentlemen, I just want to make sure that you understand that this is not a political show, and I'm not taking a political stance about anything, okay? So please do not misunderstand this. But we didn't talk about this last week, but they came in with the jobs revision for the previous year, and they said they missed by almost 1 million jobs.
A wildly high number.
1 million jobs.
Whoopsies. That
is, I can't even process that number.
Right.
How can you be that far off? And if and I say this with all love and respect, right?
Sure.
But if you kept giving me bad data that I'm supposed to make decisions with, all right, and you're revising it every quarter or every month or whatever, and so you're already revising it, right? They've been revising it all along. We revised last quarter, and now we're going to revise the whole year, and guess what? We're even wrong by a long shot for the whole year. If you're me, what would you do to you?
I think I probably wouldn't be in this room with you right now, most likely.
You would I'd fire you.
Yeah, that's it.
Right? I mean, I can't make decisions if you're constantly giving me bad information.
No, absolutely not.
So, again, I'm not being political here, but that lady that was in charge of that data, and that's what she presents to the president and to, decision makers and investors like you and me, she deserved to be fired. She should have, if she didn't come up with, this is all a mess and we need to fix this on her own, then maybe she shouldn't be in that job. So again, not politics, just are you competent in your job?
Right.
All right, so now let's look at how we use jobs data. All right, because it's so unreliable and because it gets revised, it's basically just noise. We can't rely on it whatsoever. So how much do we, when we're making our investment decisions, our sanity checks, all the stuff that we do, how much do we give gravitas to the labor market and jobs data?
0. We talk about it, right? I mean, we'd love to incorporate some level of another economic data point, but when we were looking at all of these different indicators, how do we incorporate and make good decisions? That came up with there's too many revisions. Month to month, quarter to quarter, there's no way we can use this to make timely investment decisions.
You can't. It's worthless.
So it's not incorporated.
Yeah.
We just threw it out.
And in today's day and age, how can this data be so off?
Right.
We must be using processes that were invented, back in the 60s or something. Because for us to be that far off, particularly when we're revising it every stupid month.
Yes.
You know, it's not like we suddenly woke up a year later and, oh, darn, we missed. No, we've been revising it every single month, and then at the end of 12 months, oh, we have to revise it even more by a million jobs. It is impossible for me to understand.
It is not a clear picture. I mean, maybe you could use a trend, but you'd say maybe you could use it on a trend basis over longer periods, but I don't even think with this revision, and there was actually one last year that we didn't even talk about too much.
800,000 jobs.
You just can't.
So you added two of them, and in 2 years, they were off almost 2 million jobs.
You have no idea what's going on.
They don't.
No.
Now, here's something that I think is going to exacerbate this problem, and that is AI. Mm-hmm. I think when you see what AI is doing, Salesforce announced that they've laid off practically all their programmers, and Microsoft is following suit, and other people are there. Entry jobs that people thought this is where you go if you're a young person and you want to, have a successful career. All those things are being wiped out by AI. I think we're going to see a lot of joblessness caused by AI. But I don't think, because, again, we've always said this, the stock market and the bond market are not driven by jobs, right? They're driven by profits.
Yes.
Right? So, and inflation. So, therefore, this whole jobs thing may become even more irrelevant, because as Salesforce, for example, lays off 2,000 people, guess what that does to their profits?
Oh, yeah. It gives
their profits go way up.
That's right.
And so their stock price probably will move up also, because it's driven by profits. And they're getting the same job done, so their productivity just went up tremendously. So I think as AI starts to become more and more of an influence on jobs, I think jobs are going to become even more and more irrelevant.
I think it's a really interesting dynamic that we're going to have to work through. Broader economy and even us at our firm. I mean, if we look at it in the last 4 years, this has been one of the head fakes. So everybody's been predicting recessions. We've had a bunch of layoffs started in 2022. We've had layoffs and people looking for work and all these continuing claims and new claims coming in. Your market goes higher. And this could be the start of it. Of saying it's not hurting the profitability necessarily of these companies. Yeah. They can produce the same with less.
And you and I have talked about this where why don't we just say no to AI? Why don't we, as a human race, just say no to it? We don't want this. It's going to cause massive unemployment. It probably is going to replace humankind. And I can't think of anything machines won't be able to do better, faster, cheaper than humans can.
90+% of the economy. Yeah. That's probably right.
So we're creating this thing monster that is, and maybe one day it wakes up and says, you know what, I don't like you anymore. You're like the Matrix, right? You're just inefficient. I'm going to get rid of you. I don't know. Maybe we should just say no to it. Let's live with what we got and be happy.
I mean, we got it pretty good right now. I think we're okay.
We are.
Yes.
Anyway, ladies and gentlemen, thank you for watching our weekly Market Alert video. As you may know, we specialize in working with people who are over 50, who are retired or retiring soon. And if that is you, then we would love to visit with you. We'd love to see how you're invested and maybe if we can improve on that. We'd love to share with you ideas on Social Security and protecting your retirement and Medicare, your 401k diversification if you're not retired yet, all those kind of things we want to help you with. We want to do it at no charge or obligation. So all you have to do is go to our website, take advantage of that. If we can help you, that is fantastic. And if not, that's fine too. Either way, we will part friends. So thanks for watching, and hope this found you healthy, wealthy, and wise. We'll talk soon.
Retirement Planners of America, RPOA.com.